please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
To individuals increased by as much as 30%, 30, and loan disbursements to individuals increased by as much as 27%. Now, in a base as large as ours, that is a significantly substantial kind of a growth that we saw. On an AUM basis, that's an asset under management basis, the total loans outstanding on 31st of December stood at 3,84,213 crores of rupees, which represents an increase of 18% over the previous year. If we break up that 18% into individuals and non-individuals, individual loans increased by 17% on an AUM basis, and non-individual loans increased by 21% on an AUM basis. This quarter we did not sell any loans, but if we take the last 12 months, then in the aggregate we have sold loans aggregating to 12,078 crores during these last 12 months. So if we add back the 12,078 crores of loans that have been sold, the growth in the overall loan book would have been 23%, and the growth in the individual loan book would have been 25%. Because we did not sell any loans in this quarter, the growth in the balance sheet figure of outstanding loans is higher in percentage terms than the growth in the AUM. So whilst individual loans on a balance sheet basis have grown by 19%, on an AUM basis, as I mentioned earlier, the growth has been 17%. As of 31st of December, we had a total of 41,372 crores of loans which have been sold by us and on which we earn a weighted average return of 1.27%. So we earn income not just on loans which are appearing in the balance sheet, we also earn income on loans which have been sold by us. A lot of the lending that we saw in this last 9 months has come from loans given to people in the economically weaker sections and in the lower income group. Now, under the definition, economically weaker section means people whose income is less than 3 lakhs a month, and lower income group means people whose income is less than, that's between 3 lakhs and 6 lakhs rupees. So out of the total loans that we did, 39% of the loans were in respect of people in the EWS category and the LIG category, 39%. On an average, we approved about 8,000 loans every month for people in the economically weaker section and in the LIG group. The growth in the loan approvals over the previous year in respect of the economically weaker section was 32%, whereas the growth in loan approvals in respect of people in the lower income group was 39%. Average loan for people in the economically weaker section was 10.24 lakhs of rupees, and for people in the lower income group was 17.38 lakhs. And this compares to an overall average loan size of about 26.2 lakhs. So the average loan size has actually come down in the course of this quarter compared to what it was in the previous quarter and the quarter prior to that. So last quarter, for example, the average loan size was 26.3 lakhs. This quarter, it has come down to 26.2 lakhs. If we look at the balance sheet figure of outstanding loans and break that up between how much relates to individual loans, how much is corporate loans, how much is developer loans, how much is lease rental discounting loans, the breakup would be as follows. Individual loans constitute 72% of the total loan book on an AUM basis. Construction finance constitutes 13% of the AUM on an AUM basis. Lease rental discounting constitutes 9%, and corporate loans constitute 6%. So what we have seen in the course of this year, this 9-month period, is that individual loans has kept rising. Lease rental discounting has shown a sharp increase during the course of the last 9 months. Construction finance has been more or less stable at what it was in percentage terms compared to what it was in March. But the corporate book has not grown. The corporate book has actually come down a little bit. If you look at incremental growth during the quarter, individual loans constituted 70% of the growth of the loan book during the quarter. Construction finance constitutes 26%, lease rental discounting constitutes 16%, and corporate loans actually constituted a negative 12%, giving the aggregate of 100%. If you look at a similar number on a 9-month basis, individual loans constituted 70% of the growth in the total loan book. Lease rental discounting loans constituted 15%, construction finance constituted 20%, and corporate loans was a negative 5%. The unrecognized profits on our listed investments, and here I'm talking only of listed investments, I'm not including the unlisted investments like HDFC Asset Management or our education finance company, but only on the listed investments, which would be largely HDFC Bank, HDFC Life, Group Finance. The unrecognized profits on the listed investments, which is the market price minus the cost price, as of 31st of December, stood at 1,46,203 crores of rupees. And this number, as of last Friday, was in excess of 1,69,000 crores of rupees. So there is a massive amount of unrecognized profits on our listed investments. Our book value per share on a standalone basis stands at 291 rupees a share. But if we add the unrecognized gain on the listed investments and then calculate the book value number, the number would increase to 1,389 rupees a share. Capital adequacy, a combination of Tier 1 and Tier 2, stood at 16.9%, of which Tier 1 capital stood at 14.5% and Tier 2 capital stood at 2.4%. Non-performing loans, not much change compared to what it was in September. Our gross non-performing loan number in December stood at 1.15% compared to 1.14% in September. If we look at a breakdown of the 1.15% between individual and non-individual loans, individual loans was 0.67% and non-individual loans was 2.18%. Non-individual loans is exactly what it was in the previous quarter. There is no change whatsoever. Net interest income, now different people calculate net interest income a little differently, but the way we calculate it, which is only looking at interest income without taking cognizance of dividend, without taking cognizance of any other form of income, the net interest income for the quarter stood at 2,929 crores of rupees compared to 2,575 crores in the previous year's third quarter, giving a growth of 14%. If we look at the 9-monthly numbers, our net interest income stood at 8,125 crores of rupees compared to 7,102 crores in the first 9 months of last year, giving us a similar increase of 14%. So net interest income went up by 14%, whether you look at the quarter or you look at the 9-month period. Net interest margin, same as what it was in the second quarter when it was 3.9%. Even this quarter, net interest margin stands at 3.9%. Spreads, the absolute spreads in the aggregates is again the same as it was in September. Spreads in December stand at 2.29%. Individual spreads in December stood at 1.91% compared to 1.92% in the September quarter. And the non-individual spread stood at 3.10% compared to 3.07% in the previous quarter. So marginal increase in non-individual loan spread and marginal decline in individual loan spread, but the aggregate spread remains at 2.29%. We have earned a lower amount of dividend income in this quarter. The dividend income for the quarter stood at 151 crores of rupees. Compared to 179 crores in the third quarter of last year. As you know, in the course of this quarter, we listed the life insurance company. On listing the life insurance company, the profit that we earned stood at 5,250 crores of rupees. Now, HDFC has traditionally had this policy that 30% of the profits that we make on any one-time gain like this, we would put into a contingency account. So accordingly, 30% of 5,250 crores is 1,575 crores, which has been put into a provision for contingencies account. So the net profit that has been reported, net of the provision figure, stands at 3,675 crores rupees. On a balance sheet basis, our total provision stands at 4,889 crores of rupees against a regulatory requirement of having a provision of 2,771 crores. So we carry a provision today which is 2,118 crores of rupees higher than what we are strictly required to carry as per regulation. Out of the 2,771 crores of provision that we need to carry, 1,529 crores is only in respect of standard assets, where there is no stress, there is nothing. It is just that every time we do a loan, a certain percentage of that loan amount has to be put into a provision, into a standard asset provisioning account. And out of the balance regulatory provision, 1,242 crores of rupees relates to provisioning for non-performing loans. Profit before tax, obviously enhanced by the 3,675 crores of the profit on HDFC Life. PBT, profit before tax, stood at 6,490 crores for the quarter, compared to 2,531 crores in the third quarter of previous year. But again, these figures are obviously not comparable. The percentage growth in profit looks very high at 156%. The 9-monthly profit stood at 11,756 crores of rupees, compared to 7,788 crores in the previous year, giving a growth of 51%. As I said earlier, these figures are not comparable. Now, because of the sale of the HDFC Life shares, HDFC will fall into a MAT provisioning as far as the current year is concerned. So we will have to provide taxation based on MAT. Now, based on the guidelines issued by the Institute of Chartered Accountants, the tax rate for the entire year has to be estimated, which would be the MAT rate, and that rate has to be applied in respect of profits for the third and the fourth quarters. So based on that, the tax provision for the third quarter stands at 820 crores of rupees, compared to 830 crores in the third quarter of last year. Total tax provision for 9 months stood at 2,429 crores of rupees, compared to 2,390 crores in the 9 months of the previous year. Profit after tax stood at 5,670 crores of rupees, compared to 1,701 crores in the third quarter of last year, giving again an extraordinarily high increase of 233%, which is largely because of the sale of HDFC Life shares. The 9-monthly profit stood at 9,237 crores of rupees, compared to 5,398 crores in the previous year, giving an increase of 73%. Profit after tax, if we do not consider the profit on HDFC Life shares, stood at 1,995 crores, compared to 1,701 crores in the previous year's third quarter. And if we don't consider both HDFC Life and dividend income, then the profit stood at 1,844 crores compared to 1,522 crores. The profit after tax for the quarter would have shown a growth of 17% without HDFC Life and 21% without considering both HDFC Life and dividend income. Consolidated profit after tax for the quarter stood at 6,677 crores compared to 2,729 crores in the previous year, whereas the 9-monthly consolidated profit stood at 12,280 crores of rupees compared to 7,972 crores in the previous year. So that broadly summarizes the financials for the quarter and the 9-month period. The growth in individual loans was, to my mind, the biggest highlight, plus the fact that the net interest margin was stable right through this period. Net interest income growth was reasonably healthy at around 14%. We did not sell any loans, and therefore the growth in the loan book after a long time was higher than the growth in the loan book on an AUM basis. Any questions if you have, be happy to answer.
Many would say at this point that the interest rate cycle has bottomed out. In fact, recent polls also indicate that a rate hike might be imminent. Given the light of this, expected hike in rates, how is HDFC placed, and how will this really impact the cost of funds going forward? And net, if you could explain how the spreads and margin will be affected.
Okay, first of all, I don't share your view that RBI will increase rates right away. Having said that, certainly we are at the bottom of the interest rate cycle. I mentioned that even in the September quarter when we had this meeting here, that we are at the bottom of the interest rate cycle. But I also said at that time, for the next 3 to 6 months, I don't see rates going up. And now I would say that for the next 3 months, I don't see rates going up. A lot will depend on the fiscal deficit, which we will know on the 1st of this month. If the fiscal deficit is in line with the target that was set, then I would expect market rates to actually come down a little bit rather than go up. I don't see RBI increasing rates unless in the unlikely event that there is a big big fiscal slippage. That is the only possible contingency I see why RBI would increase rates in the immediate present. So in the next 3 to 4 months, I would expect rates to remain stable, so remain reasonably stable. Having said that, we have gone through different interest rate scenarios over the last couple of years. A year and a half ago, interest rates were extremely high in India by comparison to what they are today. Then we saw a period of nearly 15 to 16 months when rates kept declining. And now for the last couple of months, we started seeing market rates beginning to inch up. So we have maintained this spread. Our spreads have always been in the range of 2.20 to 2.35. Not for 1 quarter, not for 2 quarters, not for 1 year, but for several years. If you go back to our website and you look at the presentation, investor presentation for different years, you'll see that our spreads have never gone below 2.20% and have never gone above 2.35%. So irrespective of the interest rate scenario, whether rates are high or rates are low, we would expect spreads to remain within that band. Now exactly what level of spreads it will be within that band is obviously difficult to answer.
Could you give us the quarterly figures of your disbursement growth as well? I mean, you have a 9-month figure.
Well, the quarterly, I don't have the quarterly number off the cuff, but the 6 monthly growth was, if I recall right, around 25% or so, and the 9 monthly growth is 27%, so the quarter should be a little higher than 27%.
And where specifically is the individual loan, I mean, the pockets of growth you're seeing?
I mentioned when I said that a lot of the loans have been done in the EWS and the LIG segment. 39% of the loans that were approved were in the EWS and LIG segment, 39%, which is higher than the overall growth in loan approvals. So a very large part of the loan approvals have been in the EWS and the LIG segment. And just to again recap, we do about 8,000 individual loans in the EWS and the LIG category every month on an average. And the growth in the EWS category for in terms of approvals has been 32%. The growth in the LIG component has been 39%. And that is the reason why the average loan amount has come down compared to what it used to be. Not significantly, but to some extent.
Do you share the view, as stated by some agencies, and I think we've talked about this before, that delinquencies in the affordable segment have been slightly higher than in the other, property business?
No, we don't share that view. I mentioned this several times before. We have not seen any material change in asset quality, whether it's an affordable loan or a normal loan. Having said that, my sense is that the various reports that you are referring to, which would be an RBI report and a Moody's report and I think a CARE report, is probably more to do with the fact that some of the smaller housing finance companies, in respect of whom this report is largely attributed, would have given a lot of loans to self-employed customers. Now, within self-employed customers also, you have professional self-employed, in the sense you have chartered accountants, you have lawyers, you have engineers, you have doctors, people who have a reasonably regular stream of income. And then you have shopkeepers, small shopkeepers who will have no consistency in their income. Because the small shopkeeper does not have the same credit worthiness as a better quality individual,